Welcome to the deep dive. I want you to imagine for a second that you're walking into your favorite, massive warehouse club.
Oh, yeah. The ones with the giant concrete aisle.
It's exactly. You've got that oversized kind of rattling shopping cart, and you are on a very specific mission. You are there to pick up like a huge bulk pack of paper towels, maybe some laundry detergent, and you're definitely planning on grabbing some free samples along the way.
Always the free samples.
Right. But then as you're navigating between the bakery and, I don't know, the sporting goods section, you see something that makes you do an absolute double take.
It's quite the visual.
It really is. Sitting right there, available for purchase, are physical gold and silver bars.
Just right there on the shelf.
Yeah, right next to the everyday stuff. It sounds like a joke, but it is absolutely a reality. So today, we are doing a deep dive into this really fascinating trend based on some great sources we've gathered. We're looking at a detailed blog post and a podcast script by Blair Harris, who is the CEO of First Gold Group.
A really insightful breakdown from him.
Totally. We are exploring this increasingly popular phenomenon of buying precious metals at massive big box retailers. Our mission today is to figure out if this is actually a smart financial hack or if it's just a really risky impulse buy. We want to help you navigate this market with some real confidence.
Yeah, because the juxtaposition of, bulk household items right alongside serious tangible wealth assets is just...
Okay, let's unpack this.
Yeah.
Because there is something undeniably absurd about this on the surface. We all know that feeling of walking into a warehouse store just intending to buy like a 5-gallon tub of mayonnaise.
Right, the giant mayonnaise.
Yeah, and somehow you end up walking out with a brand new kayak because it was just sitting there looking like a great deal.
It happens to the best of us.
It does. But walking out with a 1-ounce gold bar or a 10-ounce silver bar, we have to ask if this is just the ultimate bizarre impulse buy for the person who already has everything.
Well, what's fascinating here is what this trend actually represents on a macro level.
Oh, how so?
The mayonnaise and kayak scenario perfectly captures the psychology of the warehouse shopping experience, right? But from an analytical standpoint, a retailer of this sheer size entering the precious metals market is... it's a massive flashing signal.
A signal for what, exactly?
It tells us that alternative investments, specifically physical gold and silver, are definitively moving into the mainstream. It's not just a gimmick.
Interesting.
Yeah, it is a direct response to a real consumer demand for tangible, hard assets in a, kind of uncertain economy. People are looking for safe havens.
That makes total sense. I mean, if I'm buying a television, the mechanics are pretty simple. I pay money, I get a TV.
Exactly.
But gold is a commodity. It's an investment vehicle. So why are rational people actually putting these bars into their carts?
Our sources highlight that there are undeniable advantages here, and the biggest one seems to be trust.
Trust is everything. It is the absolute foundational currency in the precious metals industry.
Because it can be kind of a shady industry. Well, think about the average person wanting to buy gold for the first time. The traditional route can feel incredibly intimidating.
Oh, for sure.
You're either walking into a local pawn shop or a specialized coin dealer where you might feel like you don't know the lingo. Or you're sending thousands of dollars to an online dealer you've never even heard of.
Right, just crossing your fingers that a gold bar actually shows up in the mail.
Exactly. But Costco, on the other hand, has spent decades building this fiercely loyal membership base. They have a well-earned reputation for aggressively vetting their suppliers.
Yeah, they really stand behind their stuff.
They do. So if they put a gold bar in their display case and state it is 99.99% pure gold, or a silver bar that is 99.9% pure silver, the consumer trusts that implicitly.
There's zero fear of counterfeits.
Right. No shady back alley dealings. That psychological peace of mind is incredibly powerful. It reduces the friction that usually keeps everyday consumers out of the market.
I can completely see that. I mean, you already trust them with your groceries and your electronics, so why not your investment portfolio?
Precisely.
But the sources also point really heavily to the pricing. We all know these big box stores survive on volume and notoriously thin margins.
Very thin margins.
The sources actually break down the typical supply chain for precious metals to explain this. And I want to make sure we get this right without, getting bogged down in a math lesson.
We'll keep the math light.
Okay, so essentially, if the raw market value of gold, the spot price is, say, $2,624 or maybe $4,900, depending on the market.
The mint takes a cut.
Right. The mint takes like a 1% markup. Then the wholesaler takes a 1% cut, and the traditional retailer takes a 2% cut.
That's the standard industry flow, yeah.
So by the time I'm holding that bar, I'm paying roughly a 4% premium over the actual spot price of the metal itself.
Which, compared to almost any other consumer good, a 4% retail markup is actually remarkably low.
Really?
Oh, yeah. Think about the markup you pay on a new pair of running shoes or a piece of furniture. It's astronomically higher, sometimes several 100%.
Wait, but if I'm paying a 4% premium, I am technically starting in the red from minute one.
Yes, you are.
The actual gold in my hand is immediately worth less than what I just swiped my credit card for. So the whole game of gold investing is just minimizing that initial premium.
That is the fundamental reality of physical commodity investing. You are paying for the fabrication of the raw metal into a recognized bar, the logistics of securely transporting it, and, the dealer's overhead.
So I have to wait for the global price of gold to rise by 4% just to break even.
Exactly. The closer you can buy to the spot price, the shorter the time you need to hold the asset before the natural market appreciation pushes you into profitable territory.
Okay. That makes sense.
And this is why the warehouse club model is so theoretically attractive, because their overarching strategy relies on those paper-thin retail margins across the board. They can often compress that final retail markup.
Bringing your buy-in price slightly closer to the spot price.
Right, closer than a traditional storefront might offer. And this strategy is even more critical when we talk about the silver bars they sell.
Oh, right. The sources mentioned they've introduced 10-ounce silver bars into the mix now.
They have, and lower premiums are crucial there.
Because silver swings up and down way more aggressively than gold does, right?
Historically, yes. Silver exhibits significantly higher price volatility. It has massive industrial applications. It's used in electronics, solar panels, medical devices.
So it's not just about investment demand.
No, its price is tied directly to global manufacturing output. When an asset swings that wildly, minimizing your entry premium becomes a very necessary defensive strategy.
Okay, so the trust factor is off the charts, the margins are uniquely thin, and the break-even point is theoretically closer.
On paper, it looks great.
Right, but here's when it gets really interesting. Because if the pricing is so incredibly competitive, why isn't every Wall Street commodities broker lining up in the checkout lane to arbitrage this? There has to be a catch.
Oh, there is absolutely a catch. And it lies in the hidden structural flaws of how massive retail operations handle pricing compared to dedicated specialized dealers.
Like a technological issue.
Exactly. It comes down to the logistics of setting a price. Costco uses what we call static pricing.
Meaning they set it once and forget it.
Pretty much. They set the price for the gold or silver bar for the day, or for a specific batch of inventory, and it just sits there on the shelf or the website at that fixed number.
But the precious metals market doesn't sleep.
No, it is a globally traded commodity. The price moves constantly throughout the trading day based on interest rates, geopolitical events, currency fluctuations.
So they have a massive technological gap here because a dedicated precious metals dealer isn't just like typing a price into a spreadsheet every morning.
Definitely not. Specialty online dealers like First Gold Group use live, up-to-the-minute API integrations connected directly to global commodities desks.
So their prices are constantly ticking up and down.
By the second. Right along with the global spot price. But legacy point-of-sale systems, which are designed to scan barcodes for bulk cereal.
They just aren't built for split-second commodities trading.
No, they have to batch update their pricing.
Buying gold with static pricing is like buying a stock at yesterday's closing price when you already know the market crashed this morning. You're flying blind.
It creates a massive vulnerability for the buyer. And true investors need transparency.
Did the sources give an example of this happening?
They do. It's a highly illuminating anecdote. During one recent trading session, the spot price of gold dropped by nearly 2% in a single day.
Wow, 2% is a big move for gold.
It is. Now think about the retail buyer who purchased a gold bar at the static price that afternoon. Because the store's barcode system didn't adjust downward to reflect the live market plunge.
The buyer unknowingly overpaid.
Exactly. They absorbed a 2% loss instantly. It completely wiped out whatever advantage they thought they were getting from the store's thin margins.
Ouch. So while you thought you were getting a deal, the market just moved right under your feet.
And you're trapped into overpaying. Live pricing protects the buyer from these hidden margin traps.
That lack of transparency is a huge red flag for anyone treating this as a serious investment. And speaking of things eating into your margins, we have to talk about the literal price of admission
A
here.
membership fee.
Right. You can't just walk in off the street to buy these bars. You have to be a paying, card-carrying member.
And this is where the math really starts to aggressively work against the casual buyer. That annual membership currently sits around $65.
So if you are buying a single 1-ounce gold bar, you have to factor that membership fee into your total acquisition cost.
You do?
I see where this is going. Our sources ran the numbers on this. That $65 fee alone equates to roughly 1.3% to 2% of the spot price of a single ounce of gold.
It's a significant chunk.
So if the entire goal of this game is to minimize that 4% premium we talked about earlier, and you immediately tack on a nearly 2% membership fee just for the privilege of accessing the inventory.
You've just cannibalized your own margin advantage.
That's crazy.
If you are only buying one bar, that fee dramatically alters your break-even point. Dedicated precious metals dealers do not have paywalls or membership fees.
You just pay for the metal and the premium.
And maybe shipping, but yeah, no artificial access fees.
Okay, let's play devil's advocate for a second. Let's assume you already have a membership because you buy your groceries there anyway, so that $65 cost is like a sunk cost. You don't care about it.
Fair enough.
And let's assume you happen to check the live spot price on your phone while standing in the aisle, and it happens to align perfectly with the store's static price that day.
The stars have aligned.
The math works. So what happens when I actually try to put this thing in my cart?
Well, then you run headfirst into the physical and logistical reality of retail bullion, which is far from ideal. First, consider inventory and variety. A true investor often seeks diversification. They want different weights to allow for fractional selling later.
Like half-ounce bars or something.
Right, or different government-minted coins like American Eagles or Canadian Maple Leafs, which carry different levels of sovereign backing. But a warehouse store offers a highly restricted selection.
Usually just one design, right?
Exactly. One design of a 1-ounce gold bar and one design of a 10-ounce silver bar.
You get what you get, and you don't get upset.
Pretty much. Furthermore, they strictly enforce purchase limits, often capping it at 2 bars per customer.
2 bars total.
Yeah. And that is assuming they even have them in stock, which is incredibly inconsistent.
The sources mentioned something about this. Blair Harris from First Gold Group actually went looking for them, right?
He did. It's a very telling detail. He actively sought this product out. He personally visited Costco locations in New York, Florida, and Oregon.
3 different states.
Across all those visits, spanning multiple markets, he never actually saw a single gold bar physically available for purchase in-store.
Wait, really? Not a single one?
Not one. They sell out almost instantly, or they simply aren't reliably stocked on the floor due to security concerns.
Which means you are relying on their website's unpredictable sales windows, constantly hitting refresh and hoping you beat the bots.
It's not exactly a reliable investment strategy.
But let's say you do get lucky. You're in the physical store, they actually have one in the glass case, and you buy it. Now we run into a scenario that I hadn't even considered until I dug into these sources.
The security aspect.
Personal privacy and security. I mean, think about the mechanics of leaving that store.
It's not designed for the discrete transfer of wealth.
It really isn't. You complete the transaction at the register, then you have to walk toward the exit and hand your receipt to the checker at the door. So what does this all mean? If I buy this at Costco, I have to nervously clutch my receipt. They look at it, they look at my cart, and they look at me. That means at least one complete stranger working at a busy public retail store knows for an absolute fact that you are walking out of those sliding doors with thousands of dollars of untraceable physical gold in your pocket.
It's a massive security risk.
And then you have to walk across a sprawling parking lot, get to your car, and drive home, hoping nobody was paying too much attention.
Contrast that with a specialty dealer.
Right, they ship it.
Yeah, they ship the metal in an unmarked, highly secure, fully insured package directly to your front door. The difference in personal security is night and day.
And then years later, I have absolutely no idea who to even sell it to.
This raises an important question, and it highlights a critical blind spot for many new investors.
What's that?
Purchasing the asset is only the very first step. Critical thinking in finance dictates that the life cycle of an investment is just as important as the acquisition.
You have to plan the exit strategy.
Always plan your exit strategy before you enter the position. A specialty dealer provides an ecosystem for liquidity, not just a one-off transaction.
So let's talk about that exit strategy. How do I get my money back out when the price of gold goes up?
Well, this is perhaps the most significant logistical hurdle with big box bullion. These stores are retailers. They are explicitly not precious metals dealers.
Meaning what exactly?
They sell the bars, but they categorically do not buy them back. All sales are final.
So I can't just take it back to the customer service desk next to the guy returning a broken blender and ask for my profit.
You absolutely cannot. You are entirely on your own to liquidate that asset. You will have to go out into the market and find a reputable dealer, someone who doesn't know you, wasn't involved in the original transaction, and has no incentive to offer you top dollar.
And try to negotiate a fair resale price.
Exactly.
Which brings us to the concept of liquidity, and I really want to emphasize this for you listening. An asset's value on paper is completely meaningless until you can efficiently turn it back into cash.
Spot on. The true cost of an investment is often found in the bid-ask spread.
The bid-ask spread.
Yeah. The difference between what someone is willing to pay you for the asset and what they're willing to sell it for. Think of it like trying to sell a used car without access to the Kelley Blue Book.
You have no leverage.
None. If you walk off the street into a random pawn shop with a gold bar, you are at an extreme informational disadvantage. They will likely offer you a price well below the actual spot value.
Eating entirely into whatever profits you thought you made over the years.
Right. A dedicated specialty dealer, however, has a standing bid. They want to buy back the metals they sell because it feeds their own inventory.
Oh, that makes sense.
They offer competitive, transparent market rates because they are in the actual business of two-way commodities trading, not just one-way retail distribution.
That is a massive distinction. You aren't just buying a piece of metal. You are supposed to be buying into a financial system that allows you to liquidate seamlessly when you need to.
Yeah.
And the sources point out that the system extends way beyond just cash transactions. It gets deep into retirement planning, right?
It does, and this is crucial for how you intend to hold this wealth long term. Many serious investors want to hold physical metals within a self-directed precious metals IRA.
Because of the tax advantages?
Significant tax deferment advantages, yes. But a warehouse club cannot help you with that. The IRS has incredibly strict regulations.
Section 408 meters of the tax code, I think the sources mention.
Yes, Section 408 meter. It dictates which exact purities of metals qualify for an IRA and exactly how they must be stored. You cannot just put IRA purchased gold in a shoebox under your bed.
As tempting as that sounds.
Right. Federal law requires it to be held by an approved non-bank third-party depository to maintain its tax advantage status.
And I'm guessing the teenager at the customer service desk isn't well versed in IRS Section 408 meter compliance.
They are definitely not. Specialty dealers have established infrastructure for this. They coordinate with specialized IRA custodians, they facilitate the secure transfer of funds, and manage the logistics of getting the physical metal directly into an IRS-approved depository on your behalf.
So buying retail leaves you entirely on your own to navigate federal retirement tax laws.
And coordinate with third-party vaults. If you mishandle the asset, you could accidentally trigger a massive tax penalty.
Wow. So we've gone from the amusing idea of tossing a gold bar in with our bulk paper Powells to dissecting premium compression, API pricing integration versus legacy barcode systems.
It escalated quickly.
It really did. We talked about the nerve-wracking reality of parking lot security, the harsh truth of bid-ask spreads, and federal tax compliance. We've covered a tremendous amount of ground here.
We have, and the overarching takeaway from our sources is actually quite balanced.
It's not all doom and gloom.
No, the fact that massive retailers are entering the gold and silver market should be viewed as a fundamentally positive sign.
Because it democratizes access.
Yes, and it signals that precious metals are being taken seriously by the general public as a legitimate hedge against inflation and a foundational asset class. It is not inherently wrong to buy a gold bar there,
As long as you know what you're doing.
provided you deeply understand the mechanical limitations of the transaction, yes.
But, and this is the crucial distinction for you, the listener, if your goal is to be a serious investor intent on wealth preservation rather than just a casual collector looking for a shiny novelty, surface-level convenience shouldn't dictate your strategy.
It really shouldn't.
The novelty of the purchase just shouldn't trump the need for deep industry expertise, real-time market transparency to avoid those margin traps we talked about, personal privacy, and product variety.
And most importantly, an established buyback ecosystem.
Right, so you can actually efficiently realize your profits when the time comes.
Being truly well-informed means looking past the immediate gratification of a retail transaction. You have to understand the hidden mechanics of the assets you're acquiring.
Treat the investment with the seriousness it demands.
Exactly. Ensuring you have structural support for the entire life cycle of the asset, from acquisition to secure storage to final liquidation.
Which means next time you're at the warehouse club, absolutely go ahead and grab that rotisserie chicken.
Can't pass up the chicken.
Never. Get the massive pack of paper towels, enjoy the free samples, but maybe think twice before treating a highly complex financial asset, like a candy bar at the checkout lane.
The fundamental rules of commodity investing do not change just because the venue does.
Very well said. Which brings us to a final thought we want to leave you with today. We mentioned earlier that the sources highlight the recent introduction of 10-ounce silver bars alongside the gold.
Right.
Now, silver, as we discussed, is known for its significant price volatility. It swings harder and faster based on global industrial output.
Much more volatile than gold.
So I want you to ponder this. If massive big box retailers are starting to offer highly volatile assets like silver right next to everyday household goods, treating them almost like impulse buys for the average shopper,
It's a wild thought.
are we witnessing the brilliant democratization of wealth building, finally giving everyone easy access to hard physical assets? Or are we just seeing the dangerous gamification of financial risk playing out right there in the grocery aisle?
Definitely something to weigh carefully.
Something to think about next time you're pushing that oversized cart.
Thanks for joining us on this deep dive.